Welcome to our discussion of intermediate accounting, uh, part one, which basically deals with the assets and the revenue side of the income statement, the assets on the balance sheet, the revenue on the income statement. Now we're dealing with chapter two here. So chapter two is the conceptual framework. So we're talking about the conceptual framework which underlies financial accounting. Now, the objectives of this chapter are to provide a framework for understanding basic financial accounting theory and describe the usefulness of the conceptual frameworks and the pieces of it. So defining the objectives, qualitative characteristics, basic elements of accounting, and discussing foundational principles such as economic entity and control and revenue recognition, matching, periodicity, monetary unit, going concern, historical cost, fair value, full disclosure, and the constraints of accounting such as cost, benefit, and materiality. So these notions should enhance your understanding of the topics covered in the whole course of intermediate accounting. You've probably heard most of those terms before in your introductory accounting course, but here we're expanding them and dealing with them in a little bit more professional setting. So our learning objectives include these ones listed. So we want to identify, indicate the usefulness of the main components of the conceptual framework for the purpose of financial reporting, for reporting information to outside users of financial statements. And then we'll talk about qualitative characteristics of accounting information, the basic elements of the financial statements, which you'll be familiar with, foundational principles and constraints of accounting, and we'll talk about the factors that contribute to accounting choices. As I mentioned in the last chapter's discussion, we have more detail and more judgment in our discussions in this course than we had in the introductory financial accounting course. So whereas we basically said this is the way you should do it in 253, now we spend a little bit more time thinking about what our options are and what those options imply. And so we want to produce a set of financial statements that reasonably show the transactions of the company without introducing all of the sources of bias that we talked about in chapter 1. And then we'll finally talk about current trends, what's happening now in standard setting in this particular area of the conceptual framework. So the PowerPoint presentation, the lecture kind of follows through in these categories. So we start with talking about the conceptual framework and what it is, why we're interested in a conceptual framework, the development to this point. It's something that we've been talking about for a very long time, since the early 70s anyway, and the idea was to try to develop a set of principles that we could use to help us determine what proper accounting looks like. We talk a little bit about information asymmetry. In particular, information which is held by managers is not available to public potential investors and creditors, and so it has to be communicated through financial statements, and that can have its challenges. Then we'll talk about the objectives of financial reporting, particularly the qualitative characteristics, and so what qualities does financial information have to have in order to be useful to the users of the financial information. Then we'll talk about the elements of the financial statements, and these are fairly familiar with you: assets, liabilities, equity, revenues, expenses, gains, losses, those sorts of things. Then we'll talk about the foundational principles underlying the conceptual framework. So when do we recognize an asset? When do we de-recognize an asset? How do we measure things? How do we present and disclose them in a standard set of financial statements? We'll talk about the financial reporting issues, the fact that Canadian and international financial reporting standards tend to take a principle-based approach as opposed to an instructive or prescription-based approach. Talk a little bit about financial engineering and how the issue of financial engineering, the creativity and complexity of financial transactions impacts what we do as accountants. And then we'll talk a little bit about fraudulent financial reporting, what its costs might be and what it's how we would recognize it, and then a little bit of a discussion of the standard settings, the standard setting process in a few different settings, in particular IFRS versus ASPE, and then IASB, the international body, compared to the US FASB standard setting processes. So that's where we're going today. So what is a conceptual framework and why might it be useful? Well, a conceptual framework in accounting is it's described as a coherent system of interrelated objectives and fundamentals that can lead to consistent standards and prescribe the nature, the function, the limits of financial accounting and financial statements. And the conceptual framework benefits the benefits that the conceptual framework would generate can be characterized as assisting standard setters in being able to issue more useful and consistent standards in the future, dealing with problems in practice. Problems in practice should be solved more rapidly and consistently by reference to a framework of basic theory. Understanding of and confidence in the financial reporting process by financial statement users will be increased because there's a consistent basis for the measurements that are taken. And finally, comparability with respect to financial statements of various companies over time will be enhanced as well. Now, the history of the idea of the conceptual framework, we've been talking about this for a very long time, as I've mentioned. In particular, the 1980 CICA, the Canadian Institute of Chartered Accountants, which is now part of CPA Canada, issued a research study called Corporate Reporting, Its Future Evolution, and it represents the first, that represented the first major Canadian document related to the development of a conceptual framework. Of course, it had been talked about in the accounting research literature for some time before that. So this document discussed the objectives of financial statements and suggested criteria for the development of financial accounting standards. And in 1987, it was revised. A conceptual framework of financial reporting was published by the Accounting Standards Authority of Canada, and it was designed to assist in standard setting and education and preparation of financial statements. And it was embodied in the GAAP standards in 1988. Section 1000, Financial Statement Concepts, was incorporated into the CICA Handbook, which is now the CPA Canada Handbook. It was to be used by the Accounting Standards Board to develop standards and to help preparers and auditors of financial statements in exercising their professional judgment. So while these documents were written with the tradition and environment of Canadian financial accounting in mind, the conclusions expressed regarding the composition of the conceptual framework closely paralleled those which were derived by the FASB in the US. So they're quite universally accepted, even outside of the international financial accounting standards. The IASB, International Accounting Standards Board, recognized the need for a financial accounting conceptual framework as well. The idea was that the conceptual framework would be the framework upon which a consistent set of financial accounting standards could be based. Both FASB and IASB are working on a joint project to develop a common conceptual framework that provides a sound foundation for developing future accounting standards with both bodies. The framework will consist of 3 levels, and we'll talk about those in a moment. The first level would be the objectives of financial reporting. So that's the top of the pyramid in this slide, the objectives of financial reporting. And the second level then provides the qualitative characteristics that make accounting information useful. So we're focusing once again on the users of financial information. And we also talk about the elements of financial statements. So the objectives of financial reporting are fleshed out in the qualitative characteristics and elements of actual financial reporting. So that's the second level. And then the third level identifies all of the assumptions, principles, constraints, and the general context in which the reporting happens. So it would be a description of the reporting environment. The Accounting Standards Board has indicated that it will probably adopt this same framework for private enterprises as well. So it will be incorporated into the ASPE standards as well. Just losing my place in my notes here. All right, so the first level, the basic objectives The overall objective of financial reporting is the foundation of the framework, so that's kind of where it starts. The objective of general purpose financial reporting is to provide financial information about the reporting entity. The objective of general purpose financial reporting is to provide financial information about the reporting entity, which is usually a corporation. And the information should be useful to both present and potential equity investors, to lenders, to other creditors in making decisions in their capacity as capital providers for the business. So an implicit assumption in this is that users need to have a reasonable knowledge of business and financial accounting matters to understand the information contained in the financial statements. So it's not just, we don't just assume that everyone should be able to understand them. There is required a certain level of competence or level of knowledge assumed on the part of the financial statement preparers. And they expect the users to have that level of competence, and that impacts the way and extent to which companies present information. For ASPE, the Accounting Standards for Private Enterprises, Section 1000 of the CPA Canada Handbook states that the objective of financial statements is to communicate information that is useful to investors, creditors, and others in making resource allocation decisions, including assessing management stewardship. As such, financial statements are to provide information that is first useful for making investment, credit, and other decisions, second useful in making resource allocation decisions. And general purpose financial statements are then intended to meet the needs of key users, including particularly creditors and investors. The second level of our pyramid deals with the fundamental qualitative characteristics, or the fundamental concepts. So the fundamental qualitative characteristics that make information useful are relevance and representational faithfulness, or if you like, faithful representation. So added to this list is consistency. So the CPA Canada Handbook recognizes consistency as enhancing comparability. So it's kind of a positive thing. It helps us in making sure that our financial statements are understood over time. So a brief description of each of these characteristics, particularly relevance and representational faithfulness, would be important at this point. So relevance means accounting information is relevant if it can influence the decision of users. So it's capable of making a difference in the decision. The financial information is capable of making a difference when it has predictive value, confirmatory value, or both. So predictive value, predicting the future outcomes of the disclosing entity, the reporting entity, and confirmatory value is a confirmation of its past transactions, proper stewardship, and profitable operation, things like that. So relevance means that it has those characteristics. Representational faithfulness means that the numbers and descriptions contained in the financial statements match what really existed or what really happened. So to be a faithful representation, information must be complete, neutral, and free from material error. Completeness means that all information that's relevant, all information that portrays the events and transactions have been included, and there's no pertinent information that has been excluded. Neutrality means that information or accounting procedures are unbiased, and they haven't been selected with an eye to favoring one group of stakeholders over another group. Information that's free from material error or bias means that the information must be reliable. It doesn't mean total freedom from all error, but it means that the information presented is as accurate as possible, given any estimates. Estimates are common in producing financial reporting, so we want to make sure that the estimates are based on the best information available at the time that the numbers were developed. Complicating this is the fact that management estimates and judgments are often required, and they have an implicit bias, so it makes it even more important to ensure the information is complete, neutral, and free from any material error or bias, because management is the possessor of inside information, and so the asymmetric information which they hold it's important that they don't skew the information which they present in their financial statements for their own best interest. The enhancing qualitative characteristics, or enhancing qualities, if you will, are complementary to the fundamental qualitative characteristics. So they include comparability, verifiability, timeliness, and understandability. Comparability Information that's measured and reported in a similar manner for information that is measured and reported in a similar manner for different companies is considered comparable information. It enables users to identify the real similarities and differences in economic events between the companies. So consistency is important for that. So its consistency is present when a company applies the same accounting treatment to similar events from period to period. So it's consistent over time in its presentation. Verifiability, the second category here, exists when knowledgeable independent preparers or users using the same methods would achieve similar results or reach a consensus regarding the accounting for a particular transaction. So it's something that we can agree on. Timeliness means having the information available to decision makers before it loses its capacity to influence current decisions. So it has to be presented in a time when it's actually useful to those users in making decisions. Understandability. Understandability is the quality of information that lets reasonably informed users see the connection between their decisions and the information in the financial statements. So understandability is enhanced when information is properly classified and characterized and is presented clearly and concisely in the financial statements. There are a number of trade-offs in these qualitative characteristics. So it may be the case that timely information would be less verifiable. Verifiable information would be available on a less timely basis. So a number of these trade-offs exist. So the trade-offs of these qualitative characteristics might be necessary in the presentation of financial information, but they shouldn't be substantial enough to render the information irrelevant. If that's the case, then we may need to wait to get better information, or we might need to develop different techniques. Similarly, there are constraints on the availability of useful information, particularly materiality and cost to benefit must be considered when preparing financial information. So something's considered material if leaving it out would make a difference in the decision process. So very small numbers are usually considered not material. There are things which are very small in the amount but may be considered qualitatively material. So for example, if a company is doing things which are illegal, it may not be a substantial size in terms of the transaction, but it could be substantially impactful on the organization if they're caught. So those sorts of things might have a qualitative degree of measurement materiality other than just the quantitative amount. So a particular measurement or disclosure may not be warranted if the cost of providing it outweighs the benefits that accrue to the users. That's the cost-benefit transaction. So you need to consider whether that measurement or disclosure is justified if it's costly. If it's costly to develop that information or costly to measure that information, we need to determine whether it's actually beneficial. And so we may choose accounting standards which don't require that degree of detail or that degree of quantitative measurement if it's the case that it's going to be substantially costly. Moving along then, dealing with the elements of the financial statements. These are something that you should have at least got some acquaintance with in your introductory financial accounting course. So knowledge of the specific meaning of certain basic elements is essential for an understanding of financial accounting. So however, the specific meaning that accountants attach to these basic elements sometimes differs from the meaning in a non-accounting context. So you need to be careful that you understand them in terms of the accounting context. So these elements, as we're going to define them below, are further discussed and interpreted throughout the text. So presented below are some definitions for assets and liabilities using the current proposed definitions. So assets. Assets have three essential characteristics. First, there's some economic benefit to the entity. Second, the entity has control over that benefit. And third, the benefits result from a past transaction or event. So something that you're thinking about getting in the future, so research and development, for example, is not an asset until you've actually expended the required research and development effort to the point where there is actual demonstrable economic benefit to the entity. So if you're just doing research to try to develop new information, that usually wouldn't meet the characteristics of an asset because you haven't actually demonstrated economic benefit to the entity. Now, things which have similar characteristics, there's some economic benefit to the entity, but and the entity has control, would be things like intellectual capital. Intellectual capital is the development of knowledge and historical techniques and methods. they are not usually recorded as part of an asset because the entity doesn't have control over the benefit, right? If the people who have the intellectual knowledge are attracted to another company and leave, then the company no longer has control. So it's really difficult to describe intellectual capital as something which we can measure as an asset. So it's really important that you understand the key components. And so as you're reading through the text, make sure you pick up the idea of the essential characteristics of each of these definitions. Liabilities also have three essential characteristics. They represent a present duty or responsibility. That's the first one. The second, the duty or responsibility obligates the entity, leaving it little or no discretion to avoid it, so it can't get out of that responsibility. The transaction or event, once again, results from a past transaction or event. So if it's dependent on the outcome of a future transaction or event, it's not a liability at this point. Equity is essentially net assets. So it's a residual interest in the assets of an entity that remains after deducting its liabilities. In a business enterprise, the equity is the ownership interest. Revenues on the income statement: increases in economic resources during the accounting period, either by inflows or other enhancements of assets or settlement of liabilities resulting from the ordinary activities of an entity. So this is what the business is normally in the business of doing. Gains, of course, would be something that's outside of that ordinary activities. So increases in economic resources or reductions in increase in economic resources during the accounting period, either by inflows or other enhancements of assets, so assets growing, or the settlement of liabilities, reducing the liabilities, would be recorded as revenues. Expenses on the other hand are decreases in economic resources during the accounting period, so it's defined as during the year, the fiscal year in most cases, and it's kind of the reverse definition of revenues. So decreases in economic resources either by outflows or the reduction of assets, or the incurrence of liabilities, so the increasing or incurrence of liabilities resulting from an entity's ordinary revenue generating activities. So that refers to the matching of the expenses against the revenue. Gains and losses. Gains are increases in equity or increases in net assets from peripheral or incidental transactions and events affecting an entity, and from all other transactions, events, and circumstances affecting the entity except those that result from revenues or equity contributions. So revenues are the ordinary activities of the entity. Gains are peripheral or incidental transactions. Transactions with equity contributions are usually confined to treatment within the equity section of the balance sheet. So we'll talk about that in the next course in 354, and that is the second half of the intermediate financial accounting curriculum. Losses, of course, have just an opposite definition of gains. They're decreases in equity from peripheral or incidental transactions and events affecting an entity, and from all other transactions, events, and circumstances affecting the entity except those that result from expenses or distributions to owners. So dividends are not a loss. Note that other comprehensive income could theoretically be excluded as a separate financial statement element, as it includes elements already discussed, so it would include revenues, expenses, gains, and losses, except that they are included in comprehensive income but excluded from net income. So comprehensive income, which we'll talk about in some detail as we get further along in the course, includes both net income and other comprehensive income. So therefore, OCI, other comprehensive income, could be considered just a subclassification on the income statement. So the following things would be included as other comprehensive income in the comprehensive income statement: unrealized holding gains and losses on certain securities, changes in the revaluation surplus when using the revaluation method to account for capital assets, certain gains and losses related to the translation of foreign operations, cash flow hedges, certain gains and losses related to remeasurement of defined benefit pension plans and liabilities measured at fair value. IFRS doesn't require companies to use the terms comprehensive income or other comprehensive income. The concepts of comprehensive income and other comprehensive income don't exist under ASPE. So you can use different terms, but the idea is that you've got unrealized holding gains in a number of different accounting measurement techniques. So items would either be booked through net income or straight to shareholders' equity under ASPE, but under IFRS we would record other comprehensive income separately. Okay. Moved on past some of these things. So these definitions on the last 4 slides, we've discussed them. as we're going through. Good idea for you to understand them. So in terms of your preparation for your exams, you might want to put those on your resource sheets and make sure that you understand the key pieces of the definitions. All right, moving on to foundational principles, the third level in our conceptual framework triangle or pyramid. Foundational principles. In the practice of financial accounting, certain foundational principles are important to an understanding of the manner in which data are assembled and then presented. The following principles in the foundational principles list underlie the financial accounting structure, and they can be loosely grouped under headings of recognition, derecognition, measurement, and presentation and disclosure. So, beginning with recognition and derecognition. Recognition and derecognition is concerned with the elements that should be included or removed from a company's balance sheet or income statement. When determining what should be included or excluded, the following principles should be considered. First of all, the economic entity assumption. The economic activities of an entity can be accumulated and reported in a manner that assumes that the entity is separate and distinct from its owners or other business units. Control. If one reporting entity alone has the ability to direct the activities of another entity, even if they don't exercise this option, and if they have access to the benefits of that entity, then the reporting entity has control. And the financial statement elements of both entities should be consolidated and reported on the controlling entity's financial statements. That's something that we're going to deal with in more detail when we get into the advanced financial accounting course, which is 401. Revenue recognition. This is something you're somewhat familiar with, but we haven't spent a lot of time talking about how we actually apply judgment in determining these characteristics. But revenue is generally recognized when three things are true. Risks and rewards have passed, or the earnings process is substantially complete. We usually talk about that as completion. The measurement is reasonably certain, so that's calculation or measurement. And so that's measurement both on the revenue side and the related expense side. And third, collectibility is reasonably assured. So kind of the three C's: completion, calculation, and collectibility. So it's realized or realizable that you actually will receive the benefit from the revenue which you've earned. So this is an income statement approach in that it focuses more on the earnings process. ASPE continues to follow this in essentially the same terms. The new IFRS 15 standard, entitled Revenue from Contracts with Customers, is effective for fiscal years beginning on or after January 1st of this year, 2018, although earlier application is allowed. The new standard follows a 5-step process in determining when revenue is recognized. First of all, you identify the contract with the customer. Then, second, you identify the performance obligations in the contract, such as promises to transfer goods and services that are distinct. Third, you determine the transaction price. Fourth, you allocate the transaction price to each performance obligation. And fifth, you recognize revenue when each of those performance obligations is satisfied. So this new IFRS approach is essentially a balance sheet approach contrasted with the income statement approach, which we've used as just briefly discussed a moment ago. Oops, jumping around here. So we have discussed the idea of recognition and derecognition. Recognition and derecognition refer to the timing in which we recognize things within the financial statements, within the balance sheet of the income statement. We traditionally recognize the elements when they meet the definition, when they're probable, and when they're reliably measurable. We derecognize them, and derecognition is the process of removing something from the balance sheet or income statement. We derecognize them when they no longer meet the definition requiring recognition. The idea of control is related to the economic entity assumption. So the economic entity assumption says deals with the idea that economic activity can be identified in a particular setting or context, and so the relevant reporting entity is determined by the economic activity underlying it. So it may be the case that we have a requirement of consolidation. If we have one company which controls another company, we consolidate those financial statements together and display all of the assets and liabilities under the control of the accounting entity. So we need to consider the economic entity separate from the stakeholders, depending on that economic entity. So something like this picture, if we think of the parent company and the subsidiary, they're both separate legal entities. They actually have the status of a separate person under Canadian law. But if the parent company has control over the subsidiary, then the resources available to the parent company include those of the subsidiary. And so when we're doing accounting disclosure, we actually consider the whole economic entity as the key unit of accountability. So we would include the subsidiary's assets and liabilities in with a set of consolidated financial statements. So the idea of control, we talk about that in much more detail in the Advanced Financial Accounting course. So the idea there is that under IFRS, if a parent company has power over the investee, however its power is generated, generally with a corporation, we're talking about controlling a percentage of shares, but it can be other things. It can be the fact that you've got a unique product, and that you're the only person that can provide that product to the subsidiary. That would allow you to have power over the investee, because if you stopped delivering your product, they would no longer be able to function. So there's a number of different things we discuss in terms of what the power over the investee would be. So under IFRS, if you have power or control over an investee, you exercise control, you need to consider whether or not you should be consolidating the entire entity together. So under IFRS, we also consider the exposure or rights to receive returns from our involvement with the investee, and the ability to use power over the investee to affect the amount of the investor's returns. So if you can determine, you can demand that you get paid a certain percentage of your dividends, for example, from your subsidiary, and they have to do that because you have a controlling interest, then that would indicate that you have control. Under ASPE, it's a less detailed definition. So we talk about the ability to determine strategic decisions without the cooperation of others. If you don't have to have other members, other shareholders, for example, or directors, board of directors members, in order to determine what strategic decisions are taken by the subsidiary, then you have control, and the definition would include that subsidiary in your entire economic entity. We were briefly talking about the revenue recognition principles, and I didn't scroll forward. So once again, revenue is recognized when completion, risk and rewards have passed. So you've done substantially everything you need to do for the earnings process. So that's completion. Measurability or calculability and collectability are key to recognizing revenue. So revenues are recognized when these three things are true. So when products or merchandise or assets are exchanged for cash or claims to cash, all of you've completed everything you need to do. You don't have any issue with measurability because the value has been actually exchanged for cash. So the collectability is also not an issue. So when those three things are true, we recognize the revenue. Now, there's a change in the approach. So in Chapter 6, we'll talk about it in more detail. The contract-based approach using the 5 steps that we discussed a moment ago. Identify the contract, identify performance obligations, determine the transaction price allocated to each performance obligation, and then recognize revenue when the performance obligation is satisfied. That's basically the IFRS approach, effective January 1st of this year. And it's quite a different approach. It's called a balance sheet approach because we're talking about the obligations that we have with the customer and the allocation of those obligations. So that when the obligations are completed, that's when we recognize the revenue. So it's quite different in its tenor from the ASPE approach and from previous accounting standards. The idea of matching accountants, when we have recognized revenue, we want to make sure that we include all of the expenses that are necessary to earn those revenues. So accountants attempt to match the expenses incurred to earn revenues with the revenues which are earned during the fiscal period. So the use of accrual accounting procedures, both accrual and deferral, are sort of mirror images of one another. So the use of those accrual accounting procedures assists the accountant in allocating revenues and expenses among fiscal periods among the fiscal periods that compose the life of a business enterprise. However, matching is an income statement-focused concept, whereas IASB and FASB accounting standards are more concerned with defining what constitutes assets and liabilities to ensure that costs don't meet the definition of assets that aren't set up on the balance sheet. So as a result, these costs would be expensed in the period in which they are incurred, regardless of when the revenue with which they are associated occurs. So the costs associated with assets and liabilities could be recognized even if they're not necessarily timed to agree with the timing of the revenue and the expense recognition. So matching, income statement focused concept, and both IASB and FASB take essentially a balance sheet approach to recognizing revenue. So that's one of the things that's going to change with regard to the contract-based approach for recognizing revenue. Measurement. Elements are recognized in a financial statement if they meet the definition of an element and are measurable. So because measurement is complicated by the use of accrual accounting and by the use of estimates, accountants must determine an acceptable amount of uncertainty surrounding measurement with the use of the measurement tools. So, so the judgment that they make has to be reasonably justifiable, needs to be reasonably verifiable, with the constraint that timeliness means that we have to make an estimate at the time that we are recording the transaction. We need to give sufficient disclosure to indicate what uncertainty, if any, still exists. So the following principles are relevant to measurement issues. Periodicity. Periodicity refers to the fact that the economic activities of an entity can be divided into artificial time periods for the purpose of providing the periodic reports. Essentially, the annual disclosure is the major one, so we have a major annual report, but often large companies provide information on a quarterly basis, or even some companies, very large companies, would produce information available for the public on a monthly basis. And that periodicity reflects the fact that you need to provide information on a timely basis. So for shorter time periods, it's more difficult to determine proper net income because of the trade-off between timeliness and verifiability. So it's more likely that errors or limitations would be present in monthly and quarterly financial statements than in the annual one, because they need to make more estimates. Less of the uncertainty has been realized before the actual end of the year. With new technology, investors tend to have better information than we used to, and investors want to have more information available because it's just more characteristic of, well, life on the internet these days. So because of the presence of information and data that's being more quickly streamed, in general, the periodicity assumption is being increased in its frequency. So there tends to be pressure to give more information. Companies can issue additional information other than financial statements, such as press releases or announcements of particularly important events which affect the company. Those are not necessarily financial statement events, but they do have impacts on the value of the firm. And so they're kind of included in this idea. The existence of lots of information makes it easy for us to produce information on a more timely basis. The monetary unit assumption, since money, or dollars in Canada, is the common denominator by which economic activity is conducted, we usually assume that money provides an appropriate basis for accounting measurement and analysis. So additionally, it's generally assumed that the unit of measure, which is the dollar in Canada, remains reasonably stable in terms of purchasing power. If that's not true, if the stable dollar assumption is not true, then we might consider another measurement. So for example, if we had rampant inflation in Canada in the order of 20% per year, we might determine that the Canadian dollar is not the most effective measure, and we might use the US dollar as a stable measure of value. The going concern assumption. In the absence of contrary information, we generally assume that a business entity will continue to operate for the foreseeable future and will be able to actually realize assets and discharge liabilities in the normal course of their operations. So there's no fire sales or no liquidation This would not be the case if there was an intent to liquidate the net assets of the company, or to cease operations, or to cease trading in the company's shares. So there are a number of things we evaluate to determine whether the going concern assumption is reasonable. So essentially we look out 12 months from the balance sheet date and we determine whether it's reasonable to expect that the company will still be operating at that time. If it's not likely to be the case, then we would use liquidation accounting, and we'd use net realizable value to value the assets and liabilities. And there may not be a lot of equity left over in that situation, right? So if the company is not a going concern, then full disclosure is required. So any uncertainties that give rise to questions of the company continuing as a going concern would be disclosed in a note to the financial statements. The historical cost principle. There are three basic assumptions. The historical cost of an asset is the value at a particular point in time, usually from a two-way reciprocal exchange, and including an outside arm's length party. So it's something that you've paid to someone outside the organization. For most assets and even liabilities in financial statements, the initial recognition is based on historical cost. So GAAP requires that most transactions and events be recognized at the amount of cash or cash equivalents which were paid or received, or the fair value ascribed to them when they took place if there's no actual cash portion to the transaction. Historical acquisition cost is more reliable than other suggested valuation methods, so it's more verifiable in our qualitative characteristics. However, in the interest of relevancy, there's been a movement towards a mixed valuation model that uses amortized cost, or net realizable value, or fair value, or a combination of the lower of cost and net realizable value, or the lower of cost and fair value. So there's more and more fair value measurements being mixed in with the historical cost. Whoops, jumping ahead here. Fair value. So the fair value principle, the fair value has been defined as included here, the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So it's an emerging principle that may be more useful than historical cost for certain kinds of assets and liabilities. For example, marketable securities often use fair value because historical cost is no longer relevant. So the definition that's given here for fair value is an important one, so make sure you understand it. Standard setters have given companies the option to use fair value for most financial instruments, such as cash, investments, receivables, payables, to promote the use of fair value. Certain IFRS standards further allow the use of fair value for non-financial assets, such as investment properties, property, plant, and equipment. They can be revalued to a higher value if the value goes up since the asset was purchased. So the fair value principle would include basically a market-based measure of the value, and so the purchase price would be compared to the value in use. Essentially, most of the assets that we purchase, such as property, plant, and equipment, is intended to be used by the entity. So we would use historical cost to allocate the value over the number of periods in which that asset is going to be used. So that's the most common reason for us to use historical cost basis for the value of an asset. However, some of the assets, such as inventory, we consider the market value, the lower of cost or market. Excuse me. The lower of cost or market usually uses the exit price or the selling price for the inventory, and that's the basis for a fair value measure for the asset. So what we could sell it for today would be the exit price. The entry price is what we purchased it for in the past. So historical cost uses the entry price or the historical purchase price. The exit price is usually used as the measure of fair value, and that can take a few different forms. It can be net realizable value. It can be it can be a market price, such as financial instruments. There's actually an objective market price for shares which are traded frequently and actively on financial exchanges. So there's a number of different ways you would actually measure the exit price or the selling price to determine the fair value of assets and liabilities. Disclosure. Presentation and disclosure indicates that anything that's relevant to the decisions of the users should be included in the financial statements and should be disclosed. The principle relevant to this is, in full disclosure, in the preparation of financial statements, the accountant should include sufficient information to permit the reader to reach an informed decision about the financial condition and results of operation of the enterprise in question. This often results in a trade-off for preparers and users to ensure the information is detailed enough to make a difference to users, but condensed enough to be understandable within the constraint of costs and benefits. So users can find information, first of all, within the body of the financial statements, second, in the notes to the financial statements, and third, as supplementary information largely included in management's discussion and analysis, the MD&A portion of the annual report. So, key things to remember, to be aware of: it needs to provide sufficient detail so that they can make choices. So if they need to distinguish between different kinds of liabilities, for example, they need to have the detail to do that. But it should be sufficiently condensed so that they don't have all of the detail to wade through. They're not going to be required to do accounting when they read the financial statements. The financial statements should give them enough information to make choices. Now, it's not correct to just throw a bunch of stuff into the financial statements as a way of avoiding your responsibility to actually choose accounting methods. So the full disclosure is not a substitute for proper accounting practice. Just telling them about it in the notes does not constitute proper measurement. If there are accounting standards that tell you should measure in a certain way, you should measure it in a certain way. You can't get away with it by just sticking it into a note. There are some cases where you don't have information which you can measure, such as contingent liabilities. If you sued, for example, you don't know what the liability is actually going to be determined to be. All you can do is give note disclosure. But in general, if you can make the measurement, you should make the measurement. Management discussion and analysis, MD&A, is usually attached in the annual report in a separate section. The audit doesn't directly refer to the management discussion and analysis, but it provides information in addition to the financial statements. So the idea of the MD&A is that it's management's take on the information about the company. So they're going to look at 5 key elements which should be included in the MD&A: the company's vision for its future, its key core businesses that it's operating, and observations about the strength of the business or challenges within that business, its strategy for developing different businesses in the future, an analysis of key performance drivers and what their results were this year, and an interpretation of those in terms of how management sees them affecting the value of the business. Capital or other resources, both existing capital and potential future resource or capital campaigns to issue new shares or new bonds or new other capital sources as well. There's usually historical or prospective results, so they often have comparable information, even of ratios over time. So that's often a source of information that you may not even be able to get through the financial statements. So ratio analysis is an important comparative part of the information in management's discussion. The idea here is that management is trying to communicate to the readers of the financial statements what their perspective is, because they've got inside information. They're actually dealing with the issues on a daily basis. They're dealing with strategic issues and implementation. In addition, they should be discussing any particular risks that they face as part of their daily management operations. We can look at the conceptual framework in more detail. Now, if you can't see this on your computer screen, you might want to look in more detail at your textbook, because it's this expanded conceptual framework slide is taken directly from disclosure in your textbook. So it includes all of the details of the components which we've discussed. Financial reporting issues. It's clear that both IFRS, International Financial Reporting Standards, and our Canadian historical standards, as incorporated in ASPE, are principle-based standard setting. So we base the idea of professional judgment on the application of principles to accounting transactions, and are choices are not specified to the same extent as they are in other prescription-based approaches, such as the US FASB standards. But there are a number of factors which contribute to making judgments in financial accounting, and so those factors are the choices that you make when you're choosing financial accounting techniques or methods. Should ensure that the financial information is of high quality, so it's actually something that users can depend on. The accountants need to be aware of factors that might affect the choices, so that they make the most appropriate choices. So the factors could include some of these things as listed here. The Canadian GAAP, both ASPE and IFRS being principle-based, means that there's flexibility allowed so that you can actually apply your professional judgment to make choices between different kinds of accounting methods and accounting disclosure choices. There may be contractual and regulatory requirements, such as debt covenants in bond indenture agreements, or statutory requirements for filing your taxes. Those things need to be met, so the financial accounting choices you make would need to ensure that you actually do that. Management bonuses may be based on earnings, so management actually has a bias, a clear incentive to make things look better. So if that's the case, you need to make sure that your accounting choices don't allow management to disclose that bias to their own personal benefit, to the detriment of shareholders and creditors. Capital markets tend to focus on earnings and earnings per share, so those are extremely important measures. So we need to make sure that those are measured as correctly as possible, with as high quality as possible. So we do talk about things like the quality of earnings in comparison to the cash flow from operations. There's this little graphic is taken from your textbook once again, and so there's kind of a continuum between perfect accounting and, well, there's no real perfect accounting, but the best possible accounting and accounting which actually constitutes fraudulent reporting. So the ideal is that we account for bona fide business transactions in a transparent basis or a transparent way without introducing management bias. That's not always possible, but so there's a continuum between that kind of ideal situation to where we use professional judgment to account for transactions, and we keep in mind the critical financial statements issues that we just discussed, such as the principle-based approach, contractual regulatory requirements, management bonuses, and capital markets focus on earnings and earnings share. So we focus on those. That's generally better information than if we're incorporating bias in the information. Aggressively interpreting GAAP. So if you have accountants who tend to pick the method which makes it easiest for them to manipulate financial statements, particularly critical measurements such as earnings, earnings per share, and bonus, the basis for management bonuses, that tends to be less quality information. If you structure your transactions to minimize their impact on debt covenants, well, if you actually change the timing of your transactions so that they make your contractual and regulatory requirements fit, that can be a problem and can actually constitute fraudulent transactions because you're doing things for other than business reasons. If you enter into specific business transactions for the sole purpose of making the financial statements look a certain way, so that you can actually disclose it in a way which tends to paint a particular picture of the financial statements of the company, that is getting close to fraudulent financial reporting. So that's something, if we were discussing things such as Enron, Enron's way of structuring their business was to create these special purpose entities so that they could actually buy shares in themselves and use increases in share value to increase their earnings. And that structure was a very complex structure, specifically for the purpose of making their financial statements look better. And so ex post, looking back at it, we can say pretty clearly that the accounting for Enron's financial statements did not meet the test for avoiding fraudulent information. So it's a key. It's important that you understand that there are some biases, and you need to find ways of ensuring that the bias does not impact the financial disclosure. Looking ahead, there's a few issues such as financial engineering. Financial engineering was brought up in the introduction in the first slide that we looked at. Financial engineering is basically a process where a business arrangement or transaction is legally structured so that it meets the financial reporting objectives of the company. So maximizing earnings, minimizing debt to equity ratio, something like that. So you can actually structure your transactions in a way that makes them look better. You need to make sure that you don't do that with the purpose of presenting fraudulent financial statements. Other factors that contribute to fraudulent financial reporting. You should consider good financial reporting should be a result of well-reasoned and supported analysis that's grounded in this conceptual framework which we just talked about. Fraudulent financial reporting, however, often results from pressures from individuals or the company, and these pressures may arise from various sources, including worsening company results, industry or economic conditions might be getting worse, unrealistic internal budgets and financial statements focusing on meeting contractual, regulatory, or capital market expectations as opposed to creating value with the business operations. Weak internal controls and weak governance means that the company is not being directed in proper strategic directions. So these things all need to be considered when you're considering the disclosure of particular accounting transactions. Now, the basic theory which we've outlined in this chapter is critical to a thorough understanding of the financial accounting process. So in subsequent chapters, many problem areas are going to be discussed for each of the specific areas we're talking about. And we're going to use the conceptual framework. We're going to build upon it and expand the framework developed here in Chapter 2 to apply it to different areas. So that's basically the rest of the course and the next course as well, applying these concepts in a way that helps us to make good judgments. Now, in terms of looking ahead, IFRS and ASPE. Both IFRS and ASPE are principle-based, so they're fundamentally similar. IASB and FASB are continuing to work on a joint project to complete a common conceptual framework that they can agree on, and that's one of the major sources of differences between the International Accounting Board and the U.S. Financial Accounting Standards Board. So that's one of the major hurdles that they have to get over. There was an exposure draft relating to this conceptual framework issued in 2015. And in Canada, it's the intent to use this framework for private enterprises as well, so it should apply to ASPE as well. Standard setters continue to work on definitions for financial statement elements, recognition and measurement, derecognition criteria, and presentation and disclosure issues. So these issues are always being addressed and considered as they develop new accounting standards. But that's it for Chapter 2.